Can you speak on the significance of a deceleration in government stimulus and its impact on quads? Looks like just executive orders for some time, which is not the injection everyone hoped for. Existing money is being rearranged and UI being cut 33 to 50%.
Yeah, absolutely. I mean, I got a few charts. If you can, Eric, if you just pop into slide 48 in the deck on that. So obviously government stimulus is super, I mean, it's a very unusual recession in the sense that, you didn't see a decline in household income. And really that's just a function of the aggressive government support we saw in April, May, and June. So, we're kind of above trend from a household income perspective. If you look at the chart on the right, but the big risk is that, if you don't get the same degree of stimulus, that number is going to gap down to a lot lower than what the trend line implies, pre-COVID. If you look at slide 49, the savings rate continues to be super elevated. So households aren't spending this money because I think, just like any rational individual who knows that they've been deferring their credit card payments, they've been deferring their auto payments, they've been deferring their rent and or mortgage payments, they've been deferring their student loan debt payments. They know that those bills are going to come due in the second half of the year. And that's what we show in slide 50. You look at this cascading cliff of waning, sort of credit easing and fiscal policy support with respect to the household sector. It's just like one shot after another starting in June in terms of these forbearance programs rolling off, in terms of the relapsing of, the $600 a week enhanced unemployment benefit. It's very likely that, my colleague JT Taylor, who runs our political research down in DC, he kind of calls it the storm before the calm. So obviously DC, likes to make this thing newsy, likes to get a lot of point across in this kind of congressional infighting process, in and around major legislation. But ultimately, he has a view that we're going to, see something ultimately pass. Whether or not that process is messy in the interim, remains to be seen. One of the things I do think has been kind of sets Congress up to deliver us this chart here on slide 50. In terms of the waning fiscal monetary policy support, certainly on a fiscal policy side, is the fact that phase 2 data is sort of tricking everyone into thinking the economy is recovering. And I mentioned this phase 2 reopening process. From a quad perspective, it looks very much like a quad 1 or quad 2, depending on what your starting point for inflation is. But the reality is that's just a bounce in economic activity. That's a function of reopening. A lot of the shutdown, a lot of the decline in economic activity that we saw in March and April was really a function of closing the economy. But the damage has been done. I mean, we've definitely taken an enormous chunk out of jobs. If you look at slide 68, we're still tracking at about 30 to 31 million in total claimants, across the 8 unemployment insurance programs. And then you look at something like slide 69. We're tracking this home-based data that's part of our hyper high frequency economic data tracker, and that's already starting to move in the wrong direction. In terms of kind of getting past this phase 2 bounce dynamic, this reopening dynamic. Again, with one of the, if I can summarize everything I've been writing about for almost 6 months now, or really not 6 months, really four months now, is that the U.S. economy is going to reopen into a recession, not a recovery. We're going to reopen at the kind of a rate of change balance in economic data, just like we saw in the middle of 2008. And we're still going to be in recession. So, you take that and do with what you want. What we're going to do with that is, kind of continue to put on this straight quad 3 playbook. As I mentioned on slide 95, back in June when we published this deck, the bearish trend in the dollar takes deep quad 3 market risk off the table. You're not going to have you're not going to, it's unlikely that you see a market event, kind of like what we saw in February and March, with the dollar going down. That's just historically inconsistent. You could see it, I guess, but certainly the correlations would imply you're not going to see something like that. So we called that out in June in terms of, kind of your overall gross exposure to the markets. But again, it's what do you buy when you're long the market? Is it just the SPY? I'm going to wake up at 9:30 a.m. every day and just be long the SPY, or if I'm an institutional investor, I'm just going to be, kind of closet index hugger, or am I going to, take actual factor and sector and industry bets to outperform the SPY? That's why we work so hard, and that's certainly why we continue to work very hard for you guys.